Good evening, Wealth Our Way Nation. What is going on? It is your main man, Charles Tank Harris, the founder and chief visionary officer of the financial literacy platform Wealth Our Way, where our motto is wealth is not only for the wealthy. And I welcome each and every one of you to the episode that we passionately and preciously have entitled The Financial Power Hour. And this month at Wealth Our Way, it is our home buyers workshop. So we are doing all things home buying. Last week, we talked about first time home buyers. This week, we have, I'm gonna wait because I got to do some precursors, but we got the mortgage specialist, the Don Dadaist, my girl Liz Paris, and we're going to talk a little bit about some changes Liz has made career-wise, right back doing the same thing, but maybe different location. We'll get into all that. But before I do, I got to practice the attitude of gratitude and say thank you to each and every one of you who are here with me as I stream live across the Wealth Our Way Network, Facebook, and YouTube pages. Yes, I threw in network because we are no longer Wealth Our Way at YouTube. We are Wealth Our Way Network. And by all means, go subscribe to the new channel. I also want to give that salute to Wealth Our Way Nation, all the members who watch our content pre-recorded overnight, over the weekend, wherever they can squeeze financial literacy in. And then a heartfelt how are you to the good folks on the Life 101 platform who listen to the audio recording of this very here program. So like I said, it is Home Buyers Workshop Month here at Wealth Our Way. This is our 6th episode of the Financial Power Hour. This is the 2nd episode dealing with home buying. And we have my good friend of the program, Elizabeth Paris, on set. Liz, how are you, love?
I am wonderful. Thank you for always having me, Tank. I'm always a friend of the show and ready to dish all the info that I can and hope that your listeners do not have their brains leak out of their ears.
Well, we keep bringing you back because you always spit the hot fire like Dylon from Making the Band.
Dylon, yes.
Who's the 5 best loan officers in the history of loan officery? It's Liz Paris, because she spit the hot fire. But no, the reality is that we have you on the show because you always have the insight that our listeners not only need to hear from a standpoint of just the general information that is available to everyone, but very much the credit that I tend to get as a financial professional. I hear about you as a loan officer from my audience and from other people that we know in common, that you take what could be considered complicated subject matter and you break it down in layman's terms so that everyone can digest it, because I have found that is an art in and of itself. It is, I give you an example before we get into the meat of the subject. And of course, I'm stalling a bit to let the Wild Nation people come home from work and get on the tube. But one of the things that I am always struggling with, I share this all the time, is my love-hate relationship with technology. Mm-hmm. And I mean, so much from even just setting up my signature on my email or my phone, it just gives me more gray hair than I have naturally. And every time I go to contract with some type of IT consultant, mm-hmm. they make me feel very ignorant. I actually don't hate the experience. And the reason I don't hate the experience is because they say in every lesson you can learn. And I learn that no matter how much I think I'm talking at someone's level financially, that there's always someone who's not understanding what I'm saying. And I need to break it down even further.
Yes.
Because the IT people can't break it down enough for me.
Listen, even when you think that someone has a high level, sometimes you just say something that is absolutely a miss for them, or they're just not. You always got to take people at where they are at the moment. They may not mentally be tapped in. So my thing is just historically, it is Black History Month. So of course I'm going to just drop a little couple nuggets in there. Listen, I'm here. Okay. Historically for Black and brown borrowers, particularly Black borrowers, it's always a barrier of knowledge. It's always been a barrier of understanding. So someone speaking to you in Japanese Latin, which is literally how finance would sound to us for generations, because we just didn't have the education, the information, the exposure. Now you're starting to see that gap of knowledge get smaller and smaller. So for me, it's big about, okay, how would I explain it to my parents? My parents are immigrants. How would I explain it to them? They've done a great job figuring out how to get things done here, but there's a lot they don't know. So if I had to teach them how to text, and I did, and it was painful, I have to I think about, how do I present information? And if I'm not clear enough, I need to figure out how to water it down more so people understand.
I
Right?
love it.
That's it.
I love it. So what I want to do before we get started, although you are a repeat offender around these parts, I want you to introduce yourself, shoot your bio out to people real quick, a brief bio, and also talk a little bit about your move, because you moved from one entity the last time we saw you here to a new entity. Tell the people about that.
All right. So again, my name is Elizabeth Paris. I am a loan officer, mortgage loan originator, loan consultant. I write mortgages. That's the ease of it. Okay. I've been in the industry for over 6 years. It has been a wild ride. I actually transitioned from the medical industry. I was in medical school, and my Instagram is Medicine to Mortgages. Pretty explanatory there. I was in the medical mental health field for well over 7 years. Is probably longer than that. And we made the life transition from medical school to being a doctor to say, hey, we're going to go into finance. I'm really making that simplistic. There's a podcast, check it out. So that's where I've been from a career journey and a personal growth journey. As for companies, I am now with Movement Mortgage. You can look it up. I promise you, you'll love it. I don't necessarily always say that, but telling Tank off screen, I'm not always super excited, but I got really excited about what this company is doing, not only in the mortgage realm, but also in community. And honestly, our reach as professionals isn't just about what we can do, the numbers and loans that we can close, but it's about the effect we have on the clients that we serve. So big on serving is who Movement Mortgage is. And just in the title, Movement, they're going to keep those deals moving. You give me clean deals, or even if you give me a little complicated, I'm gonna figure it out and it's gonna get to the settlement table. Okay. that's my little.
We love that. We love that. And like I said, one of the things that I've told people about my journey as a financial professional, it's very, very seldom that you see a professional or even the firm itself end up where it started. There are so many firms out there that aren't named today what they were named when they started. There's been mergers, there's been spinoffs, there's been acquisitions, there have been bankruptcies. So for me, starting out as a quote unquote stockbroker 25 years ago now, at Smith Barney, like I literally got there and it was called Smith Barney and they gave me business cards. And then it became Solomon Smith Barney like 6 months later. And then the parent company of Solomon Smith Barney, which was Travelers Insurance, merged with Citibank to form Citigroup. And then we got a third set of business cards. So, people change all the time. What I try to tell people, it's not a function of where I happen to hang my hat. It's that I'm still wearing the hat.
Yep.
And the reality is that sometimes we make changes so that we can learn more, but more often than not, especially the quality people who stay in an industry, we make changes so that we can better serve our clientele.
Yes. So
let's get right. I'm sorry, what did you say, Liz?
And that was the move. I knew I could do much more for my clients, so I'm here.
Let's get right into the heart of the matter with mortgages and just the environment. I think there's been a lot of concern that I've heard in just the back channels about all of the talk around rising rates, all of the talk about. Now, I know, once again, the process of buying a home has so many moving parts. And as such, professionals like yourself have to be well-versed in not just your specialty, but the other areas. So even though you deal on the lending side, I'm sure seeing house prices rise the way they have has also altered how you do your business. So let's talk about the market in general. What you're seeing, what you're experiencing from people who are coming to you for mortgages. Here's one of the other things that's a hot topic. Are certain mortgage products sexier to sellers than others? And as such, are sellers who can be really picky in this market right now, telling people, well, we don't even want you if you're going to come to the table with that.
Gotcha. Well, let's start with what we're seeing, at least from the inventory standpoint. Now, we've been at low inventory for well over a year now. We kind of saw it tick up around the beginning of the pandemic. That was 2020. And we've kind of just been watching it kind of roll downhill, where we're just seeing less and less homes available. And that's universal in the marketplace. Pick a state. there's going to be some limitation on what's available for buyers. With that being said, certain rules are certain rules are consistent, meaning right now it's wintertime, it's cold, right? There's going to be snow, at least on the East Coast. There's going to be snow, rain, freezing rain, and anytime we can get a blizzard, that's well up until end of March. So it's actually a good time for borrowers who don't have a super large budget, meaning you're probably going to be under $250,000 of a purchase price, to be looking for a home if you're trying to buy a home, which means you needed to get pre-approved last September, last October. Note that that's about a 4-month gap between when you got pre-approved and when you're really hitting the market to search. So that's actually another tip right there. Start 4 months ahead. If you can, start 6 to 7 months ahead, especially if you know you're trying to buy within the next year or so.
Let me stop you there. I want to take a deeper dive because we know now this isn't, I know you're used to being on 15 minutes of finance and we have to squeeze a lot in quick. We got time to wrap tonight. So let's really dive down on things so the audience gets the real jewels and gems that you bring to the table. Here's what I'm going to speak from a standpoint of not a professional financial guy, but as a home buyer. Okay. Here's what's confusing to me. I hear you say, go get a pre-approval because I need to be forward thinking as to when I'm going to buy, but houses are flying off the damn screen so quickly. How do I operate in such a space where there's a sense of urgency on my part to buy when inventory is available, getting pre-approved? And I know the pre-approval is not associated with a particular home, it's associated with a home budget. But how long does a pre-approval last? So I get pre-approved, how long can I shop with it? And what exactly does it mean? I mean, let's get real kindergarten right now. Okay. What is a pre-approval and how does that help me?
Right. So a pre-approval lasts for 90 days. Now, be careful with that because sellers are hip to the fact that that's a 90-day window. They may say, this looks a little old. We need to update it pre-approval when you place an offer. And I'll get into what placing an offer means in a little bit. All right. But when we're talking about getting pre-approved, the pre-approval is when a lender such as myself or someone else for another lending institution looks at your W-2, 2 years of W-2 income, your 30 days of pay stubs, your 2 months of bank statements or other assets such as retirement, stocks, investments. And then depending on if you're self-employed, we look at 2 years of tax returns. And then we look at credit, which means we pull your credit. We put a hard pull, meaning we pull from all 3 bureaus, and it is going to be a hard inquiry onto your credit, which means it'll take a couple dips and points. We look at all of those items to then discuss with you budget, what you qualify for, and then max purchasing amount. That then allows me to issue a pre-approval, which means I have looked at the credit, I've looked at your assets, your income, I have run it through something called automated underwriting on my side as a lender to make sure I have a clean mortgage pre-approval. And then I issue you the letter. Pre-qualifications, which you'll hear that a lot, is when the lender goes off of your verbal income, verbal credit. They don't pull credit. They just kind of go off what you tell them. And that pre-qualification doesn't matter.
Got it.
Sorry to tell you, it doesn't matter. It is not valid. It will not get you an offer accepted. You have just wasted about effectively 10 to 15 minutes of your time. This is not the market to do pre-qualifications. This is a market to be serious about your purchasing power, your budget, and getting your credit pulled. Hard inquiry.
Perfect. Let me ask you this question then. With the pre-approval, speaking from a layman, a purchaser of homes, how, on a percentage basis, 0 being not even close, 100 meaning, of course, it's a done deal. How close am I to being approved in reality because I've gotten a pre-approval? Like, because it feels, I bought a home a few times, but it's been staggered. So I bought my last home in 2008, 14 years ago. I don't really remember the process, but I remember having a pre-approval. But then I still remember going through Tank, bring me this, Tank, oh, change this, Tank, do this. So it wasn't as though the pre-approval was done. All the heavy lifting was done. And when I found my home, I didn't have to do anything additional because I was already pre-approved. So now I got the house, I'm approved. What's that gap?
So I can't say I know a solid percentage point. I'm just going to talk for myself as a lender. I'm pretty thorough and I have to be. And the reason why I have to be, depending on programming, there's a lot of moving parts. So depending on the borrower, If you're W-2, chances are you got a pre-approval and your loan officer was thorough, that percentage should be somewhere around 95%
Okay.
getting
Much
through the
higher than
mortgage
I thought.
crisis.
Much higher. Okay.
And let me put a little caveat, a little asterisk there. You as the borrower have to be honest with your lender. You cannot leave anything to chance.
Yes.
Tell your lender everything, not the processor, not the underwriter. Talk to your loan officer.
Yep.
I might get in trouble for that. Anyway, but talk to your loan officer. Tell your loan officer every single aspect because we don't want surprises. There's a person who approves the loan called the underwriter. You may have heard crazy stories or myths about underwriters. I like to equate it to marriage. They say happy wife, happy life. I'm going to say happy spouse, happy house. So your underwriter is your spouse or your wife in the marriage. If they are unhappy with what they see on your file or something pops up that makes it complicated or not approvable, you can get denied. So you have to tell your loan officer everything up front, give them everything they ask for up front. You will need to redo and give some updates, but that's how you ensure a 95% pull through from pre-approval to a mortgage approval. And mortgage
I love
approval.
that. I love that. I want to say something that I've experienced firsthand with clients that I've worked with financially, helping them get houses, which piggybacks on what Liz is saying. Whatever you get pre-approved on, you have to keep that energy throughout the process. You know, and Liz will talk about it. I know she has stories like bad date stories where people have done what they needed to do to get pre-approved. And then they're like, oh, I'm getting a house. Let me go down to Raymore Flanagan, take out 2 credit cards and get my furniture so I'm ready. It makes logical sense to us, right? But now we done messed up what we got pre-approved on. And now the underwriter is going to say your credit score dropped further, your debt to income is off. So talk about what not to do between pre-approval and purchase.
Oh, easy. I got you. Your credit should not be touched. The only person touching your credit is your lender. Once you get that first pre-approval, nothing else touches your credit. So you're not going to Raymore and Flanagan. You're not going to shop for a car. You're not doing anything except paying your bills on time and saving your money until you close on the house and get the keys in your hand. So first things first, keep your credit clean. No more inquiries. No co-signing. I really roll my eyes really hard. I'm sorry. No co-signing. Not even before you get the pre-approval. I want to be very clear about that. I don't care if it's your mama. I'm sorry. No co-signing. You set yourself up for failure if that person does not pay that bill. You're taking on a lifelong debt, not a 30-year debt, not a 5-year debt, because defaulting on co-signed liabilities stays with you. So no co-signing, no credit inquiries, nobody checking your credit, not depositing cash, green, dinero, into your bank account that you cannot source.
What is sourcing?
Meaning we have a paper trail to see where that money came from. So
why is that important? That's one of the things that a lot of my clients are very frustrated with when that happens. You would think I got more money, like I'm better off than I was when I started this process. Why does that drive underwriters crazy when new money comes into play?
Because of the issue with money laundering, fraud, and sometimes other illegal activities that occur in the world. And this came back from different CFPB policies that came into play. There was a lot of issues in 2008 where folk had stated income and they just taking mattress money, tossing their bank accounts. People were not verifying and validating where it came from. So people said they had certain assets they really did not have, or that they had certain income. So understand that there's a lot of trauma from the 2008 mortgage crisis that led to a lot of legislation coming into place. And so now you see the results of they have to source deposits. They have to source where money's coming from, because people would take out loans to get a loan. Make it make sense. That's double the debt and you can't even really pay the bill. So no lender wants to hold that liability of a defaulted mortgage or mortgage that went into foreclosure. At the end of the day, this is a business. Yes, I'm here to help you. I'm here to build generational wealth, but I work for a company that's about business because they have things to do too. So no, we have to verify your cash deposits. Make sure if you have cash deposits from business, you're a cash run business, just have it sourceable, have your receipts, have your invoices to show and correlate where that money came from. please do not use Cash App and just drop money into your account from Cash App that's been sitting for 6 months because you just use it as a way to pay for things. It understand that bank underwriters and underwriters across the general people are, it's getting better, but it's a foreign concept. It's like trying to teach, again, my parents to text. They're senior citizens.
Let me ask you a question, because you bring up an interesting thing. And once again, I've been through this process before, but we have something new since the last time I purchased a home in the form of cryptocurrency. Mm-hmm. And so I'm gonna talk as a financial professional. I know one of my boys who I have on the show, shout out to my man Devlin, who comes on and does some cryptocurrency talk for the nation. Mm-hmm. Devlin said, we were talking about some of our coins. They were doing crazy good the other day, and they're so volatile. He said cryptocurrency makes for a strange mistress. And, it's true. Like, if you don't have the stomach for it, you gotta be careful. But I bring this up to say, mm-hmm. when you talk about verifying assets, and I come to the table with my Coinbase Pro account, and it's got $72,000 in it. There's a saying in finance, all money ain't the same money. Right now, to your experience, how are mortgage institutions looking at cryptocurrency accounts as it turns, when somebody says, I keep all my money in Coinbase, here's a $100,000 statement. Mm-hmm. When we know we could look at that same statement in 9 days and it could be $41,000.
$41,000, right. So in regards to crypto, and I say this because I've closed a couple clients who had crypto assets, and they liquidated some of it in order to put towards, their down payment. We're fine. Again, crypto or Coinbase, I can't speak for all wallets or all platforms for cryptocurrency. They have statements. They do. You can literally print off statements in 3 months, 2 months, or certain increments to show certain assets or what's accumulated. We asked for, again, 60 days, right? That's 2 months. Whatever it is at that time, if it ages out, then we'll ask for an updated statement. So we're fine with that because it's sourceable and we know where that money's coming from. It's when it's random wallets that don't give you that type of printout.
Perfect. And I love that answer. The other thing I want to ask, and we'll move on from the pre-approval process, mm-hmm. is if I'm house shopping, is my pre-approval associated with a type of loan that I may get, or is a pre-approval a pre-approval? Is it conventional pre-approval, FHA pre-approval? How's that process work?
So it all depends on what makes sense for your financial situation. And I can't stress that enough. FHA is a great government-backed insured program. It's phenomenal. But if you can do conventional and that makes sense financially, then we're going to look at conventional options. I typically present my clients with what options make sense for them. And then we decide what program they're going to be pre-approved with. To answer a question you had earlier about preference for sellers, it truly depends on the seller. They like conventional pre-approvals more, and that has more to do with the appraisal process than it does with anything else.
So what's the difference in the appraisal process between the conventional loan and the FHA loan?
Mm-hmm. Great question. So because FHA is a government insured loan, government backed, they won't insure the loan if the property's not held to a certain standard. So where you may have chipped, peeling paint, the FHA appraiser is going to say, hey, I need that scraped and painted. Where there's railing not done on a wall for stairs, we need that railing installed because it's a safety hazard. If there's an active leak in the roof, which I think everyone should get that fixed. That's not just the FHA thing, but your choice. They want that repaired. If there's mold or certain things in basements where the walls aren't properly treated, I forgot what it's called, they're going to ask you to repair it. So where a seller just wants to kind of unload a property quickly and have the least amount of headache and get a specific type of value if they're real estate savvy, they may lean on conventional buyers more than FHA. Is it fair? No, it's not. Should somebody regulate it? Probably should. But this is where I would suggest getting yourself a realtor who is very savvy in the market, has good connections, meaning people know their reputation. Getting that type of realtor helps you remain aggressive. So it shouldn't matter if you have conventional or FHA if you got the right realtor on your team, but understand that some sellers, they may say it on the listing, cash or conventional only.
Something interesting, and I'm not sure, and I know you'll handle it with grace either way, if this is something that you've dealt with before or not, but I've just recently been introduced to these companies that are offering lease to buy for people.
Mm.
I haven't seen one yet that I would recommend to a client. They, and I'm just going to say it out loud. They can sue me if they don't like it. The one I've seen is Divvy. Divvy, I feel like you're buying your house twice if you go through Divvy, but that's just because I know numbers and I looked at their sheets and they look crazy. However, the one good thing about a company that you would get in bed with like this is they got cash. So you see a house and you want it and you want to go through their program. Once you're approved, they're knocking on the seller's door with a check and buying it. So closing is like that. Now you're in bed with Divvy and you got to deal with all that nonsense. But for anyone who's not ready to buy, what are your thoughts on those types of programs? How would you tell somebody who's not ready to buy yet for one reason or another? Income is sketchy, credit's not good, whatever the case may be, but they want to get in the house. This program is knocking on their door, sending them internet leads saying, hey, you can be in your house today. What would you say about that?
So I have closed a client who went through Divvy. Divvy does have their own like internal lender. I worked my way there and was able to be the lender on that. The client they really had it together. They got themselves built up and they closed. For rent to own, it's very important that you have an exit strategy because it is very, very easy. And I've seen it even with like seller rent to own contracts. It's very easy to say, okay, rent to own, we pay this rent, and then eventually we'll own the house. But something that happens mentally to us when we think we've accomplished the goal, but really we haven't, but we're kind of already in a space, is we forget we have things that we're supposed to be staying on top of. Like my credit should be improving. I should be saving money in order to buy this house in 2 years because there is a contract. You need to be in a position to buy for most rent to own situations before you end up with for seller contracts, sometimes it's like a balloon payment, something weird. Or I don't know. I'm not quite certain what it is with Divvy. I didn't comb through their contract fully, but you have to have your exit strategy and you need to be as disciplined as humanly possible. I don't mind the programs. I find that unfortunately, I think they're predatory.
Yes.
Because a lot of times you are gunning for folk who have very marginal credit and you're not giving them, to my knowledge, you're not giving them resources to now increase their marginal credit. You are getting them in a position to pay the rent, but you're not giving them any resources to get them out from renter to owner. And that's the part that's dangerous to me.
Yeah, and I agree with you on that. And I'm keeping a close eye on one institution in particular that's coming out because it's supposed to be the institution that Puffy and Jay-Z and Will Smith are behind. And I want to see that one be for the people because West Philly Willie is my guy. Jay-Z is my idol.
Will better come to Philly. He better come to Philly first, and he better tap these Philadelphia realtors that I know who work with the clientele who could benefit from that. I'll get into it later. I'm gonna get in trouble. Will, I'm gonna hit up Jada on Instagram and hope. That's how I feel about that. If you're about to do it, make sure you're tapping the local realtors in the areas you want to target. You need to rope in the folk who know the lay of the land.
Excellent. Great advice.
I'm watching it and I'm just like, I like it. I see who's behind it, but I want to see how it plays out. So
I feel the same way. I think what was it? Reverend Run's brother, Russell Simmons, got so much grief and probably rightfully so for the rush card. And, we play our black card and we go out in the hood and we sell to our people. And we as predatory as some of the non-black people that come into the hood. And that's doubly disgraceful to me. So I really, really want to see if the Jigga Man and West Philly Willie really get their stuff together and do this program correctly for the people.
We're going to see. I like to call it the photo negative version of colonization because that's really what it turns into. And it's unfortunate because I get that, again, everything is profit-based. We live in a capitalist country. I understand that. But there's a way to do it with morals. So I wasn't a fan of the rush card. I've seen a couple clients come over with them over my career, and I've literally told them, get out of this card, close it down. Here's better secure cards to build your credit and to work with.
Excellent.
In our bank accounts, because I don't like predatory things.
Excellent. One of our Wild Nation members, Carla, has a question. I've never heard this term before. Sounds like something I'd like to do on a Friday night after I leave the club, but I'm not going to get into that. Not going to get into it, Liz. What about tangled titles? I
am actually not familiar with the term either. I'm not afraid to say I don't know something, but Carla, if you could give a little bit more information in the chat, and then hopefully I can I can give you a little bit more insight because I'm not familiar with the term, and I'm honest. I don't know.
Yeah, I appreciate that. Like, I saw it. I was like, "Ooh!" I had to adjust my glasses to make sure that word said,
you know what? Okay,
to make sure it said titles. I didn't know what we were talking about here.
Next question, because you're about to tangle my morals. Okay, my morals about to be tangled.
So here's the thing. I want to talk about the different programs because I'm freaked out by the first of all, I give the United States of America a very hard time. So let me clap my hands for the United States of America over the last year, the way they've been throwing money at everybody, even in the Black community. We've been getting money, making it rain. I saw a funny meme earlier today, though, that said the PPP loan has showed me what you people would do with reparations. That had me crying. Like, we've taken this money and we've done some wild things with it in the community. But my point of bringing this up is there are some programs out right now to buy homes that I can't believe are out. 3% and no PMI, no money down. Like, talk to me about, I'm a first-time home buyer, or I'm just trying to get my feet under me and I want to get out this renting situation. What programs are sexy right now?
There's quite a few. I'm always going to plug this one first because I always feel like our vets, and they should get the best situation on God's green earth. 0% down, 100% financing. If you are a military vet, that's a win. Active duty as well. That's a win. I can't say anything else. And if you're a first-time home buyer and the state that you're buying in offers state grants, say less.
Get it.
Say less. Carla, I'm gonna get to you. I promise. But I'm gonna speak on a broad spectrum because I'm licensed in a few states. Every state has different grant programs. So I'm going to tell folk now, go to HUD.gov and search housing counselors, and that will bring up different housing counseling agencies in your area that will allow you to go sit in their first-time home buyer sessions and learn about all of the grants available in your state.
I love it. That's great information. And I think we got some clarity or some expounding on what tangled titles mean. Basically saying it's an inherited home that mortgage may or may not have been paid off. So we're probably talking about transfer taxes and all types of other things. So if you could jump on that, Liz.
I'm gonna get to it. Give me a second. Let me finish up the grants because we're bringing this to the end of the day. You'll lose me. But I will say this: there are 3% down conventional mortgage programs with no PMI. Those programs do exist. I would advise that clients who are looking to use those programs, because you want to save money, minimize your out-of-pocket, you make sure you have a 680, probably tip it towards 700 credit score and up. The reason why I say that, the market has been very aggressive and volatile in the sense of rates have been moving. We're still in the middle of a global pandemic. To take advantage of those programs, you got to have strong credit and minimize your debt load as well. Okay. FHA is always there, 3.5% down. That's always a good opportunity for you to buy single family or multifamily because it's always going to be 3.5% down. Whereas conventional, the down payment goes up if you're buying a 2-unit or 3-unit home. Something I don't hear a lot of loan officers talk about because of the complexity, but rural area loans, USDA, a lot of places still qualify for USDA loans, and that's where you're in a rural area. They call it, usually people think farmland, but you're talking about maybe less than 50,000 people in the area. A lot of areas still qualify for that. And USDA is also 100% financing.
Wow.
Now, it does have income limits, household income limits, but that's still a great opportunity for a lot of different families where you may not necessarily want to go 3% or 3.5% down, and you're not military.
Okay.
So no special grant needed for a USDA loan. So go USDA.gov, I think, but hit me up as a lender. I can walk you through some of that information. Now I think those are the most general options that I can think of for first time owner occupied, which means you're living in the home, it's your primary residence, options. Again, each state's going to have a different program. New York's got $100,000 program for their buyers. Philly's got $10,000. They got another grant that's out that also helps you with your down payment or closing costs. Maryland has programs. Delaware, again, I could go on. Now, Carla, in regards to Inheriting a property, and if it has a mortgage, you're gonna have to get it refinanced into your name. That's the only way to clear that up. So if there wasn't a specific will, I hope there was, so it doesn't end up in probate. But if there's will or documentation saying that you have ownership rights, you're gonna have to get that refinanced into your name in order to take over the mortgage. There's no other way to do it.
Okay, that's great information. Appreciate that. And you can always, we're going to do like a little bit past halftime break to let Liz give you her contact information, because if any questions you have, one of the reasons I bring people on 15 Minutes of Finance and the Financial Power Hour is to not only give my audience insight that otherwise I'm limited on and can't give them, but to also highlight professionals that I trust and want people to talk to and glean for information. So Liz, what is your new professional contact information?
Oh, wonderful. So it is elizabeth.paris@movement.com.
And I'm going to put that in the chat. And that's Paris with 2 R's. Y'all see it up there on the screen.
2
At
R's.
movement.com.
Mm-hmm.
I love it. So tell me if I put that in there correct, because Big Tank is many things, but a typing professional, not so much.
I'm minorly blind. You said I got to check. Yes, you got it right.
Perfect. So I want to pivot. We were talking about programs. Let's talk about who's not ready. Let's talk about, because I have a niece and she better be watching this. And if she's not watching it live, she better watch the recording. She's putting on Facebook, I need to get a house. I need to get a house. Your uncle's one of the best financial planners in the country, let alone your city. And I've been helping her get her stuff together. But she likes to go off on her own every so often, as younger people do. But with that being said, I've always heard, but I've heard it from people who make money selling houses, that everybody can buy a house. Can everybody buy a house?
Eventually.
Some people ain't ready today.
Not everybody's going to be ready today. I'm going to tell you this right now. If you have no clue what your credit score looks like, any of them, at least 2 of them, and not from Credit Karma either, you're not ready to buy a house today or within the next 6 months. If you don't have at least $5,000 saved, and I'm being very light on that number, I promise you it's probably a little more, you're not ready to buy a house in the next 6 months, not in this market. If your credit score is under 600, can I do it? Yes, I can. But there are certain things that come into play where divorcees, we get it. Things happen. Sometimes their credit score drops because of, commingled debts. But a lot of times there's at least assets there, right? Mm-hmm. Yeah, there are assets there. There's lots of money saved. There's retirements. There's longevity in their career. So you have money to put together in order to buy a home when your credit is above a 550 but under 600. I would still tell you to go ahead and take a little time and work on your credit, but I understand that the dire need is there. If you are under the impression that you won't have to put any money into buying a house, you're not ready to buy today, probably not tomorrow or 6 months. You might want to go talk to a housing counseling agency and find out what it actually takes. I like to stress to people, as much grant money that exists in the world, and there's quite a few programs, you still have to put in at least $3,000 of your own money, at least. And I'm being generous because of the market we're in, and it's aggressive. So you're not ready to buy. If you have previous foreclosure that hasn't properly seasoned out, I gotta look at my chart that I have on the wall. Looks like 4 years, you're not ready to buy. If you have a repossession on a car, you're not ready to buy. If you are in default on your student loans, you're not ready to buy.
You finish those thoughts, because I want this to keep going. But you said student loan. I'm going to keep it in my head, something I want to ask you.
If you owe taxes and you have not started a payment plan and made 3 payments, or at least 1, depending on the financing options, you're not ready to buy. So more to
love that. Yeah. A lot of those things, I had to check those boxes myself. I think, my audience, I had a really, really great letter written to me by Lindsay Bronner. Shout out to Lindsay. She's one of my most endearing, all of Wild Nation. Y'all know I love y'all, but Lindsay just makes me happy when I read her stuff. She just sends me some of the most glowing testimonial conversation. And she said to me, one of the things she loves about Wealth Our Way and me in particular, if I can humbly say, is that I always share my missteps and my stumbling. You know, I share what goes wrong with me. I have no shame. I was born with no shame. I don't know how that happened, but I have no shame. And plus, Lindsay's in the building. Hey, Lindsay. So, you know, one of the things, because I have no shame, I have no problem telling people where I messed up. And also I'm a baller, like, you know, so I messed up. And I was talking to someone earlier and they say, beware of the people who can make a bunch, lose it all and make it right back. Those people are trouble. Hello, I'm those people. So after my divorce, I had to file bankruptcy. You know, I had a stay-at-home wife for 17 years. I made on average about 500 grand a year. This woman never worked. He went into the court like, you know, I never saw her look so bad going into the court, telling them how disheveled and disenfranchised she was and how it was my problem. And I needed to keep her in the lifestyle to which she had grown accustomed. So I got advice from people who knew better than me. And they said the best way to ever be able to have money ever again was to file for bankruptcy. So I did it. I'm a professional. I do what my people tell me when I think it's right. I have been building back from bankruptcy. I thought, first of all, and here's, you know, Murphy's Law will always get you. I filed a Chapter 7 bankruptcy in February of 2015. Now, for those of you who know nothing about bankruptcy, that is supposed to be your quick and easy $99 special bankruptcy to file. The state of New Jersey told your boy Big Tank, you're not bankrupt. They contested my bankruptcy. It's supposed to discharge in 6 months typically. My bankruptcy took 2 years and 5 months to discharge. Now, mind you, when I filed bankruptcy, one of the biggest things that they sat me down and told me was the 10 years, this will be all behind you. 10 years is a big number anyway, but 10 years, it'll be all behind you from the date it's discharged. I bit the bullet and rolled with that. But now, instead of 6 months from the day I do it, plus 10 years, I had 2 years and 5 months, and now 10 years.
There you go.
I've been spending since July of 17 rebuilding my credit. Shout out to Capital One. Yo, if you got bad credit, holler at the good people of Capital One, because they gave my fresh out of bankruptcy ass 2 credit cards, and the Navy Federal gave me a secured card, and I was able to build my credit score up from a number that was almost negative to the mid sixes like that. And now I'm pushing 7. It's amazing out of bankruptcy to be pushing the 7. Now, yes, I know before anybody says it, I make a lot of money. I'm just gonna keep it funky. And it helped me do things that other people may not be able to do. But I bring all of that up when you talk about bankruptcy. I have tax issues. I'm a small business owner. Show me a small business owner who doesn't have tax issues. And having the process of getting on a payment plan, making sure those 3 payments were made. I did all of that to put myself in a position to buy. But I've been wanting to buy a home now for a minute, but I knew I couldn't. And it bothers me sometimes, the level of entitlement that people feel like I'm supposed to have this house. Like I'm sitting here making good bread, and I know that I wasn't ready to get a house. Now I'm ready. And of course, I'm in one of the hottest sellers markets ever. But, you know, that more Murphy's Law.
Listen, I think, and I say this to a lot of clients because everyone's caught up in rates are going up. It's a competitive market. And I'm a big fan of do the work, lay the foundation. What's supposed to be yours will inevitably be yours. But I'm going to be frank. You could have bought a house before now. It would have bled you through the nose, Tank.
Yeah.
It would have been a high rate. It would have been a seriously high down payment. And it wouldn't have felt good. Not that, you know, everything has to feel great. The mortgage process is what it is. But the reality is folk have to understand, all right, if you're not in a dire situation, and there are very few situations I consider dire for trying to buy a house at a time where you're not financially in the best position to do so, then you do the heavy lifting now, lay the foundation now. Let's talk about it in 6 to 8 months, depending on what's needed. The reality is more people have to wait than not. Instagram makes it look great. You know, you see everybody doing oh yeah, we bought a house, I'm an investor. You see all of these things. HGTV makes it look amazing. Let me help y'all out. Take your time, lay your foundation, because that house does not have a maintenance man for you to call who's going to come fix whatever's going on with your house. It's coming out of your pocket. You're not responsible for all the payments. It's not an eviction, it's a foreclosure that can completely derail your credit. Take your time with this so that you can get the house that you want. It's okay to say, I got to wait a year. I had to wait quite a few years with me, leaving medical school, getting my credit in order. It took me, I wanted to buy a house back in 2014. I just bought a house last October.
I want to move into the concept of buying versus renting. I'm asked, so all month we're doing home buyers workshop. I have realtors on last week. I'll have realtor on next week. And then in week 4, I'm bringing all of you guys back to have like a round table to talk about what new home buyers should expect their first 90 days inside of a home. So I know you'll have a lot to add as far as, hey, all these different monies, now we got to furnish this joker. Now we got maintenance, we got landscaping.
Especially if you bought a income producing property because you wanted to house hack. Let me tell you,
it's gonna be crazy, but we got to get all of that done. One of the things that I have now, I have a daughter. I have 5 daughters, but I have a daughter who's a homeowner, 28 years old. She house hacks. She has 5 roommates paying for her house. I have another daughter who's living in the great city of New York, and real estate through the roof there, of course, always. What I would say is people in the new generation are thinking that buying a home is what their dad and their granddad or their mom and their dad and their grandmom did. It may not be for me. It may be that renting, having upward mobility, not being tied to a process. Also, and I got to be fair as a financial professional, I let everybody know I'm pro home ownership. But, if you're not in one of these programs that are minimizing down payments or eliminating down payments, the down payment process comes out of pocket. The closing costs, and we'll talk about closing costs versus down payment, because I think when people hear no money down, they hear no money. And
that's not the case.
They're not hearing closing costs. But I say that to say, I was talking to a young person, very bright, and they were giving me the argument for renting versus buying. We had a great conversation, and they were saying I could take the $15,000 to $30,000 that it would cost me to get into a house, put it into an investment, rent. And yes, my rent may be higher than my P&I, which is principal and interest on my mortgage loan, but I'm never paying taxes. I'm never paying homeowners association. I'm never paying homeowners insurance. I'm never having to get my lawn cut. If I factor all these costs in over a 30-year period, I feel as though I make out better renting. And we had a conversation. The numbers did not support their argument, but they were marginal. The numbers were marginal. When we really were fair about all of the ins and outs, it wasn't that big a difference. And this person said to me that $27,000, which is what the difference was, I would gladly pay that $27,000 cost, amortized over 30 years, so it makes it $900 a year for the freedom of not owning a home. And I said, you know what? You made such a valid and educated, informed argument that you're ready to go do your thing. For most people, they don't ever do that type of research. What do you find when people are weighing out renting or buying?
So I'm big on what makes sense for you and your 5-year plan. I have a client who makes money. She does IT. She wants to rent. She doesn't want the headache of house hacking. She doesn't want to pay the mortgage. She doesn't want any of that, but she's investing in businesses, things like that. My thought process is it has to make sense for your 5-year plan. If you're in a space where you're mobile enough and savvy enough financially that you can put your money into investments and you can reap those rewards and rent is not killing you, great. That's not the case for everybody. Some people are in a position where home ownership really is the better option for them because it will lower their monthly expenses. And yes, there's lawn care, but I promise you they got a family member who will take care of it. Okay. Or I have folk who do condo living, and that makes more sense for them financially, especially in places like New York.
Yes.
New York will bleed you through the nose. So will LA. So you have to pay attention to what makes sense for where you are renting versus, well, if I get this home, maybe I live in Brooklyn now and I found like a good multifamily and I can get that. Or I go to North Jersey and I'm just in Newark and I can get a house where my mortgage payment is only $2,000 and maybe I saved $800 because I was paying $2,800 for a 1-bedroom, 1 bath in New York.
Yes.
You have to weigh your marketplace versus what your next goal is and what you're paying in rent. Because I promise you, I'm not trying to
So
I had to live over it.
Let me say this. I went ooh on you when you said student loans. I had Dr. Genevieve Dobson, shout out to Dr. Jen, student loan expert extraordinaire, on a few weeks back. And she was talking about some of the changes that have been made with the Biden administration as how they are looking at student loan debt as it pertains to mortgages. Drop the science on us.
Oh man, let me tell you, life got golden. I think it happened right around last year. And I hit up all my friends who are medical professionals and lawyers and engineers, like, hey y'all, come talk to me. Or even just, high level professionals have a lot of student loan debt. So here's the thing. Conventional has always been very, very flexible with how they look at your student loan. So I'm going to start with them. If you have a conventional finance option, 3% down, one of those no PMI programs, they will look at whatever's on a credit report and take it as your monthly payment when they're trying to calculate debt to income. And debt to income is basically all of your monthly debt divided by your gross monthly income. Okay. That ratio is really important in getting you qualified for a home mortgage, and also figuring out your budget. So conventional will say, oh, Yana, it says $0 on the credit report. Fine. We'll take $0. Here's where the revolution happened. FHA typically, for God knows how long, would say, all right, you have student loan debt. We're going to take 1% of the balance. Imagine you have $400,000 worth of student loan debt. They took 1%.
$4,000 a month to your debt to income.
Towards your debt to income, even though you were on an income-based repayment program of $150. FHA said, sorry, we're going to take 1%. That kept a lot of people from being able to buy a house. A lot. They either had to wait to build their credit to go conventional, or they just they weren't buying a house. Now FHA says, okay, listen, if your student loan balance or your student loan is in deferment or forbearance, we're going to take 0.5% of the balance, that's helpful. Not if you have $400,000 worth of loan debt. It's still better than, $4,000. But here's the other thing. FHA also said, well, listen, if you're on an income-based repayment program, and as long as that payment is greater than 0, we'll use that instead. Game changer.
No doubt.
Especially for me, because I did take advantage of that rule when I bought, because I have a lot of student loan debt because I was in medical school. So I do well for myself financially, but I promise you, I can't be able to student loans just yet. So
I know that.
But it's helpful. It's changed the game for a lot of my borrowers. We're able to get them into loan programs, particularly with grants, because grant programs are more restrictive than FHA or conventional in your debt to income ratios. Whereas, FHA may say, hey, you can be up to a 50 or 55%. Some grant programs will say you can't be over 43% debt to income. Ooh. So that's another thing to pay attention to. So this rule on the student loans has changed the game for a lot of borrowers. So again, find yourself a good realtor who knows the marketplace. Find yourself a good loan officer.
No doubt. We found her.
So that you can get into a home, or your families can get into a home, even if it's FHA, even if you have student loan debt.
I appreciate that. So, we're going to throw one last question out there because we're getting toward the tail. I told you, it's still, we can pack a lot of information in, but before you know it, that's over too.
And I have all the information. I'm like, ooh.
There it is. It's a lot to squeeze in. That's why we're going to bring you back at the end of the month, though. So before I ask this last question, I want to know, when people come to you, so most of the time you're getting referrals from realtors, or are you getting direct buyers hollering at you?
It's a
mixture. So when people come to you, do you get the, hey, I'm ready to buy a home and I look halfway decent, or do you get the, break glass in case of emergency clients? I think I already know the answer.
I do get a mix. I do a lot of consulting, and I'm fine doing that. But I also have a lot of clients that I work with to get numbers out to them quickly who are ready to go. But I do get a lot of break glass emergency clients, because a lot of times it's just a lot of misinformation. So I'm very big on educating and redirecting and say, hey, here's what you need to do. Let's talk in 90 days.
I appreciate that.
Mhm.
Here's what I'm going to do. I literally love all of this. Audience, do y'all love this? Like, is Liz dropping jewels for Wild Nation today? I want to make sure everybody knows where to find you. So if you could just one more time tell everybody your email address and your website so they can know where to find you.
Absolutely. So my email address is elizabeth.paris@movement.com. So my first name dot my last name at movement.com. You can find me on Instagram at medicine, the number 2 mortgages. I have a little bit of humor there and I give all kinds of tips and tricks. So like, follow, share. I do give jewels there too. But you can, if you feel like hearing my origin story, I'm a little bit of a superhero. Not really. I have a podcast called Medicine to Mortgages. I actually talk about how I got into the mortgage industry after being a medical student for 2 years.
Love it. Love it. And then also, everybody, shameless plug, Wealth Our Way has a new YouTube page. It is Wealth Our Way Network. Please subscribe. I am on a chase to get to 1,000 subscribers. I know it's a heavy lift, but they give you the little bell inside your videos that point to, I got to have it. I got to have the bell. So please go to Wealth Our Way Network and subscribe. On Instagram, we're at Wealth Our Way. Facebook, we're at Wealth Our Way. We're building something big to continue to give you information on all things financial literacy. This is the Home Buyers Workshop Month here at Wealth Our Way. We have Liz Paris on today of Movement Mortgage. Last week, we had Mike Headley of the Headley Real Estate Group. Next week, we're going to have a special guest talking about the difference between using a real estate professional versus peeping Zillow and Trulia and Realtor.com and just what's real and what's not real. And then the last week, we're going to have everybody back for a panel. And what my goal is, I want you all to get into a home. I mean, that's what I do here. Like, if you're new to the program, if you haven't checked out 15 Minutes of Finance, I don't know how much I could get naked on the screen, but I'm a big man and it's not everybody's flavor. I could strip down to my bareness, but I'm bearing my soul for you guys to try to show you how much I care about you financially. And I don't know what else to do, but I come here every week. I'm here 3 times a week now. I used to be here 5 times a week to give you guys what you need to get into a house. So continue with the emails, continue with the inboxes, continue visiting the website, wealthourway.com, so that we can continue to build for you and your family financially, because I only got one thing that I say every day. I mean, that's not true. I say a lot of things every day, but the thing I say the most every day and to the most people is what we're going to close out with today, 2 minutes early, because yes, I'm rushing out to go see my son's middle school, catch the second half of my son's middle school game. Wealth is not only for the wealthy. So come back next Wednesday. Liz, I so thank you and appreciate you for being here today.
Be here.
I hope Wealth Our Way Nation got a lot out of this. And I will see you guys on 15 Minutes of Finance tomorrow at 12:30 Eastern. And next Wednesday, I'll be right back here on the Financial Power Hour. Yo, there's my guy down there. Gratitude, baby. So, I appreciate everybody checking in today. And we'll talk to you guys later. Wealth is not only for the wealthy. Have a great evening.
Good night.